This digital graph from May 6, 2010, captures the exact moment the Dow Jones Industrial Average plummeted nearly 1,000 points. Within a few minutes of trading, $1 trillion in market value vanished from the global system. On traditional trading floors, brokers watched in shock as the screen data defied economic logic. For a brief window, shares in blue-chip companies like Procter & Gamble were trading for as little as a single penny. Regulators first suspected a human fat finger error, but data analysts later identified ultra-fast, repeating algorithmic patterns that had never been seen before. They called these sequences market crop circles. This was a systemic machine failure. The trading infrastructure had entered a feedback loop that no human operator could initially decode or stop. For 5 years, the official investigation concluded that the high-frequency trading machines had simply malfunctioned on their own. That changed in 2015, when investigators traced the origin of the crash to a quiet, semi-detached house in West London. 31-year-old Navinder Singh Sarao was a day trader working from a bedroom filled with stuffed animals. He used a standard PC and a basic internet connection to manipulate the digital logic used by Wall Street's most expensive algorithms. This modest suburban setup had triggered a systemic shock that bypassed the security measures of the global financial infrastructure. The order book lists all buy and sell requests. Sarao used dynamic layering, placing massive fake sell orders above the current price. Seeing this phantom wall, bots panic sold, driving prices down. Sarao bought the cheapened contracts, then canceled his fakes, rebounding the market. Sarao didn't need to be faster than Wall Street's algorithms. He simply weaponized their predictability, turning their own speed into a vulnerability. But spoofing is risky. If a real buyer had appeared and filled those massive fake orders, Sarao would have been liable for billions of dollars he didn't have. He hacked the exchange's queue logic, where first-arrived orders fill first. If a real buyer approached, his software instantly changed his fake order's size by exactly 1 unit. This modification reset the timestamp, sending the fake order safely to the back of the line. By mastering this obscure mathematical rule, he could bait the world's most sophisticated bots with zero risk to his own capital. While he made $70 million, Sarao never changed his lifestyle. He drove a car worth £5,000 and used coupons to buy food at McDonald's. His neurodivergence allowed him to see logic where others saw chaos, but the same trait made him uniquely vulnerable in the physical world. While he was outsmarting global markets, real-world scammers were swindling him. He lost nearly $50 million of his fortune to simple Ponzi schemes and fraudulent investment programs. The trader who successfully deceived the global futures market found himself defenseless against basic real-world grifters who stripped him of his wealth. Because he was essentially broke and provided extraordinary cooperation to investigators, Sarao was spared prison. He was sentenced to home confinement in the same childhood bedroom where he had executed his trades. In the years since, regulators have implemented sub-tech AI and market-wide circuit breakers. These systems are designed to pause trading the moment an algorithmic feedback loop starts to form. There is still debate over whether Sarao truly caused the crash. Many experts believe the market was already fragile, and Sarao simply lit a match in a forest dried out by the noise of high-frequency trading. The story of the Hound of Hounslow remains a warning. In an automated world, the greatest risk isn't a lack of speed. It's the fact that machines can be manipulated by anyone who understands how they are programmed to think.